Hey guys, Optic here, and today I'm going to be covering my USDC USDT trade. So I'm gonna explain to you how price is booked, and through that I'm gonna explain to you why I decided to enter this. Okay, so let's start with how price is booked. Price is booked based off the last traded price. It has nothing to do with volume. It has nothing to do with, let's just say the market cap is 100 bill, so that means you need $1 billion to move price by 1%. It has nothing to do with that. Price is booked by the last traded price. Okay, what do I mean by that? Right, let's go to the equities markets. Sometimes you see that price trades a certain way, and then it ends the week, let's just say at this price. Okay, ends the week at this price. New week opens at this price. This was maybe 1%, a 1% move. Let's just say. What is this gap? This gap is the gap between the closing price and the last traded price on Sunday's opening. Okay, and between this price and this price, only one contract was traded. Wait, how is that possible? Are you really telling me that an asset class that is worth trillions of dollars, right, like S&P 500, was moved by 1% with only one contract? Yes, that is exactly what I'm telling you, because that is how price is booked. It's all a scam. Okay, you can look it up. If you don't trust me, you can look it up. This is how price moves. So if price closed here and opened here, moved by 1% with only one contract, then that means price is a scam. This means the price tag is a scam. So what must we resort to, right? If the price tag on the charts is a scam, what must we resort to? Well, you must resort to the true and fair value. What is the true and fair value? Now here is where volume can come in. True value, let's just say for USDC, any USD stable coin is gonna be $1, because that is a true value of it. It's actually worth $1. People want to buy or sell it for $1. On S&P and assets like that, you can look at the areas with the highest volume, and those areas are likely the areas with the fairest price. Why? Because that is where most traders agreed to buy and sell. Those areas that had the highest volume are the areas of fair value. So when we have a gap like this between a closing price and an opening price, and only one contract was traded between it, this area is an unfair price. Was unfairly priced. And why does this matter? Why does this matter that it was unfairly priced? Imagine an auction, okay? Let's just say you're participating in an auction. You're participating in an auction for some car, okay? And now this car, you bid 10K, somebody bids 15K. You bid 20K, he bids 21. You bid 22, he bids 23. Now you bid 24. Now he gets tired of you. You bid 24K and he gets tired of you. And he now decides to bid 50K. So now price went from 24K to 50K. Okay? And now all of a sudden, hypothetical scenario, he gets sniped from the distance, shot in the head, and he dies. So this means there is no longer somebody willing to buy at 50K. So does it make sense to you that the seller is going to expect you to pay 50K for that when you didn't get to participate on that pricing? No, it doesn't make sense, and you're not going to agree to buy at 50K. So where is price going to come back to you of that car? It's going to come back down to fair value, which is at 24K. Why is that? That's because where you agree to buy and he agrees to sell. Okay? So over here, there was only one contract traded in a market that has volume of billions of dollars. Only one contract versus billions of dollars of volume. This is unfair. Okay, and price is likely to return to this price down here. Okay, because that is more fair than this price. Now, how does this have anything to do with USDC? Let me show you. I'll show you exactly what it has to do with USDC. So if we go on the daily chart on USDC, and you zoom out a little bit, right, you can see that at the peak, price was at 1.8698. Do you really think that that people were actually willing to buy at 1.8698? Do you really think that people were willing to buy a coin that was worth $1 for $1.8698? No, there were not. There was maybe one, or there was a very little volume. There was very little volume traded at this price. Price spiked up to here because there was a lack of liquidity in the books and somebody had a sell limit precisely at this point. So any buyer that there was who entered with a market order would have gotten paired with this guy up here. But this coin was never actually worth 1.8698. It's actually worth $1. Okay, and that is why it stays around $1. Okay, so all of these spikes mean absolutely shit. So how did I know, and how was I so confident that when we dump down here, how was I so confident that we're going to recover? I'll explain that to you right now. The reason we dumped, right? So what these companies do, right? What these companies that offer stablecoins do is they tell you, okay, this coin is worth $1. We are going to keep it at $1. And the way we're going to do that is by using our large resources to scatter loads of buy and sell limits below, slightly below and slightly above $1. And this way, price will stay around $1 and it won't go below that. But what happened? How did it go below that, right? When Silicon Valley Bank crashed, they lost $3 billion. That means they did not have the means to continue holding price around this area. So what did they have to do? Well, what they had to do was find a way to make that $3 billion back, since they can't hold price up here. So what happened to price? Price dumped. Why is it dumping? Because they're no longer holding price up here. They're no longer willing to buy at this price. So that means that this move down is happening because they're no longer providing liquidity up there. So what is this maneuver? This maneuver is being engineered by them so that they can make their $3 billion back. How is that? Because this dump causes normal retail traders to panic sell, thinking USDC is going to go to zero, causes them to panic sell, and this allows them to accumulate USDC. This allows the guys who run this, right? It allows them to accumulate USDC at a lower price than 1, and then later they can sell it back at 1. So if they used to have their limits, let me just draw a fake chart. Okay? So if they used to have their limits, right? Let's just say this is the price of 1. If they used to have their sell limits here and their buy limits here, now they get to move their buy limits down to here and keep their sell limits here. And then what will happen is we'll see something like this. And then they made money off of this entire maneuver down. Why? Because now they got to buy down at this price and all of these prices, right, as well. And they got to sell it back up here and then keep price up back up here. And this is why you see those spikes. They're simply maneuvers that they make to make their money back. And then average retail traders lose money on this shit. And it fucking pisses me off, but, well, gotta make money. So when you see an opportunity like this, that's when you capitalize. You gotta think with a brain. How do we capitalize on things like this? Now, if you want to get more political about this, after the FTX collapse, all of the exchanges started posting reserves, proof of reserves, proofs of holdings, etc., which led me to believe that because USDC is listed on so many exchanges and they have such vast holdings of it, it just made no sense for me that USDC would go to 0. And if it's not going to 0, it's going back to 1. So also BlackRock is a company that manages $8.5 trillion in assets. And they have a stake in USDC. So that also led me to believe that USDC is not going to 0. And if it's not going to 0, then it's going back to 1. And this is not the first time we see these maneuvers. They've happened many times over and over and over again, such as here, such as here, such as there, etc. They've happened many times. They're normal stop panicking. Use your think with logic over here, okay? I hope you guys gain value out of this. Peace.